Hello dear traders. Credit rating agencies have once again raised concerns about America's credit risks. As last week's trading was coming to an end, on Friday news broke that Moody's had reaffirmed the country's top AAA credit rating while changing its credit outlook to negative from stable. This revision was attributed to significant increases in government spending and ongoing political polarization. Government bonds are becoming less available to investors as yields rise and Congress struggles to reach a consensus on fiscal expenditures. The Biden administration has refuted the justification behind the downgrade in outlook. However, these denials by the White House are unlikely to change investor sentiment. Notably, Moody's is one of three credit agencies that still maintains the US rating at the highest level. In light of these events, let's see how other significant events of the past week influenced the movements of major trading instruments in the currency and commodities markets. Last week, Fed Chair Jerome Powell took the stage twice, making investors think that the Fed's interest rate might be raised once again. As a result, the US dollar index, which reflects the dollar's position against a basket of 6 other major currencies, ended the week higher by 0.68%. The dollar might have gained more strength if not for the news about the negative outlook on the US credit rating. In the Eurozone, statements from monetary authorities also caught the attention of investors. European Central Bank President Christine Lagarde commented that the current interest rate is enough to bring inflation down to the target level. This suggests that the ECB is unlikely to increase its rates, triggering speculations about the upcoming easing of monetary policy. Markets now anticipate a potential decrease in ECB interest rates by 95 basis points by the end of 2024. Meanwhile, the British pound faced bigger losses last week. The Bank of England also remains committed to combating inflation. Investors are awaiting new consumer price growth data this Wednesday, but for now, they are digesting the news about the British economy. Preliminary data shows that the UK's GDP remained unchanged in the third quarter, indicating economic stagnation. Although this is better than a decline, the stagnation is not a positive sign, which keeps the pound under pressure as it tests the support level at 1.2200. In the meantime, the Japanese yen continues its downtrend and retreats against the US dollar. Powell's hawkish remarks starkly contrast with the Bank of Japan's position, which emphasizes maintaining an ultra-loose monetary policy until inflation stabilizes near the 2% target. As long as the Bank of Japan sticks to its dovish stance, the yen is likely to keep attracting the seller's interest. As investors turned their sights to the US dollar, gold prices came under pressure last week. Gold marked the second consecutive week of declines, falling below the level of $1,940 per troy ounce. The rhetoric of the US Federal Reserve not only strengthened the dollar but also increased capital inflow into US treasuries. Besides, the demand for gold as a safe haven asset weakened amid diminishing fears of a broader geopolitical conflict in the Middle East. Oil traders also faced losses last week as the changes that other oil-producing countries will get involved in the Middle East conflict reduced considerably. In addition, this downturn was influenced by aggressive comments from the Federal Reserve, which negatively impacted the forecasts for energy consumption by the world's largest economy. Pessimism was further fueled by statistics from China, the world's largest oil importer. However, it's unlikely that oil will drop below $80 per barrel. We expect prices to stabilize in the area between $80 and $85 per barrel. These are the trends of the last trading week. Do not miss our daily news reports to be always in touch with the latest events. See you!